I'm now delighted to be joined by a fantastic panel. We have Alessandro Caroli. Alessandro has been working in climate advisory for over a decade, covering energy policy, low-carbon innovation, and sustainable finance. He leads the sustainable finance team at Vivid Economics, a sustainability consultancy acquired by McKinsey & Company in 2021. Before joining McKinsey, he worked for Lloyds Bank Group, the Carbon Trust, and the World Bank. We also have Martin Brown, who has spent 20 years with law firms, including 10 years as a partner, during which he was regularly recognized as one of Singapore's leading transactional maritime lawyers. He joined BW Offshore in 2021 to be their lead counsel for project structuring and financing, and is the most senior representative of BW Offshore's corporate finance team in Asia. And last, but by no means least, we have Geir Bakkelund. Geir has a long experience as a shipping banker and previously a shipping analyst and broker. And he now leads the ship finance team at National Australia Bank. So today's topic is about balancing long-term energy transition with short-term energy needs. As everyone in the room will be aware, sustainability has been a key focus globally in recent years. And for the shipping sector, that's meant a particular emphasis on decarbonisation. While there's undoubtedly been progress, I think we can all agree that there's still a lot more to do. I actually read an article last week suggesting that while shipping may be on target to meet zero net carbon by 2050, we're still a long way from meeting the Paris Agreement target of 1.5 degrees C for climate change. And as well as trying to meet these climate change ambitions, we now have to contend with the current energy crisis, largely driven by the aftermath of the conflict in Ukraine. And it's interesting to see the reactions and how this has affected the market. Some countries, like Germany, Austria, and the Netherlands, are reopening coal plants as they revert to fossil fuels in an effort to obtain energy security. At the other end of the scale, Rasmus Bach-Nielsen from Trafigura, who I know spoke earlier today, made headlines last week by announcing that Putin's war had actually accelerated decarbonisation by around 5 to 10 years. So I'm really keen to hear what our panelists have to say on these particular topics. Martin, perhaps I can start with you. As a company that's actively involved in energy transition, what trends are you seeing from the current energy crisis, and what short-term impact is this having on your business segment?
Thanks, Lizzie. I'm going to do something similar to Lawrence and start with a few statistics. In the last 40 years, energy consumption has increased from 40,000 terawatt hours to 160,000 terawatt hours. So a quadrupling in our energy needs. In that time, renewables has only increased by 7,000. So it barely makes up a tiny, tiny fraction of the increase in energy demand. What we need to bear in mind is that that vast amounts of energy are needed, as has been said earlier, to create the alternative fuels that ship owners have been looking at. And another statistic, which is quite interesting. Last year, $420 billion was spent on exploration of oil and gas, with 507 spent on renewables. However, renewables only make up 5% of the energy mix compared to 57%. So what we're looking at is vast amounts of money being pushed into the energy transition with actually, in the short term, fairly limited benefits. This is a very, very long-term game. From our perspective, as a company, we're involved very much in the production of energy and floating assets which produce energy, from oil and gas producing assets to floating wind, and we're also looking at alternative fuels as well, so the production of hydrogen, methanol, ammonia, and so on. But the challenge then is going to be, where does the energy come from to produce those? And this goes back to the question that Mr. Nielsen talked about earlier, was the difference between what is green, what is blue, and grey. Aha, I'm on. Sorry, that threw me off. Yeah, so what we're seeing is a massive amount of interest in oil and gas and the requirement for floating production systems, because there is such a need for energy in the short term whilst renewables are being developed. Our floating wind business gets massive amounts of interest from bankers particularly. It looks good on their CVs. But at the same time, those projects have a lead time or an FID of 10 plus years compared to about 3-4 years for an oil and gas project. They're a long, long way from making money. So to answer your question, Lizzie, I think generally we're looking at, there's a lot of interest in both hydrocarbons, and we can come back to the question of gas as a hydrocarbon and decarbonisation later, and also renewables, but one of them just doesn't make money. So at least it doesn't at the moment.
Some very interesting statistics there. Thanks for sharing. Alessandro, given your sort of perspective and ability to kind of have an overview of the market generally, interested to hear what your thoughts are in terms of what we're currently seeing. So Martin talked a bit about the fact that energy transition is very much a long-term process. But in the short term, are you currently seeing a sort of resurgence in these fossil fuel transactions? And is that something you're expecting to see?
Thank you. Yes, indeed. We are definitely seeing an uptake, especially for obvious reasons, in LNG demand from Europe. And we expect to see possibly up to 20% of global LNG demand coming to Europe to replace the Russian pipeline gas that is currently unavailable and is likely to be unavailable for the medium term at least. So on gas, the pressure is unlikely to go away, even though the European Union policy announcements, the repower plan, etc., also make renewables a centerpiece of their energy independence strategy. But nonetheless, yes, pressure on gas is likely to continue to increase. On the coal point, that is also true. I think in terms of statistics, I've seen a projection of an expected 14% increase in coal demand from Europe as well in the short term. Again, this is expected to be less long-lasting perhaps than the gas one, because of course there remains a strong climate policy infrastructure in place, which the EU has given no signals of intending to abandon. In fact, they have signaled they might increase their ambition and announce it at COP27 now in November in Egypt. And so I think the short term, the demand for coal might increase, but in the very short term, so it might be more of a blip. And then the final one around oil, I think we see more uncertainty there. Right now prices have been decreasing, but it depends a little of how the situation will evolve over the winter. We have sanctions coming in on Russian oil from the EU in December. We will see how effective those are. If Russian oil is taken out of the market to a greater extent, then we might see more pressure on oil as well in terms of prices. And again, that also depends on what we were hearing about the Chinese slowdown and how that might affect growth in demand. So overall, it is a mixed picture. It is a highly uncertain picture, but in the immediate short term, there's definitely an uptick, particularly on gas and to some extent on coal as well.
That's interesting to hear. And Geir, sort of, looking at it from the banking perspective, do you think that the current energy crisis is going to have an impact on the bank's lending criteria and the commitment that we've seen so far to ESG financing?
No, yeah, I do. Actually, I think it will only enhance it. Certainly, speaking to my own colleague in London on the renewable and green financing desk, it's much more discussion. It's more projects being talked. I mean, obviously, this, to Martin's point, take a long time. It's political, but I think for our own bank, definitely leaning more towards financing green and renewables. I think the issue, with oil and gas has always been that, the vast majority of the fields are in jurisdiction which are deemed less desirable, in terms of political risk and jurisdictional risk. Lots of the green financing, the renewables are much easier from that perspective. It's so often produced in the country where it's consumed, so it's easier to to finance in that matter. And I think that's what we see internally. I think in terms of ship finance and the energy transition, I don't think the crisis in Europe really have an impact as we speak, but maybe in the long term, but I don't think it really affects the way we think and look at ship finance. But certainly from a more broader corporate finance lending, it certainly has enhanced it. And I think the last point I want to make is more the people, consumers' opinion, right? So I mean, you mentioned coal is coming back. I don't think really consumers in Europe are overly keen on that. And I think that that could be a catalyst to enhance the transition to greener and more sustainable energy production.
Thank you. And Alessandro, as Geir pointed out, going back to fossil fuels, it's not something that's particularly popular with the public, not really something we want people focusing on. So what advice would you give to companies to ensure that they keep their focus on track in terms of energy transition?
Yeah, I mean, I think I agree, and I think the point on coal is that it's going to be very tactical and short term. As I mentioned, the policy framework remains much more orientated towards renewables, and in a sense, in terms of the energy options that exist for Europe, but for other regions as well, yes, there is quite a spread into how quickly renewables can be scaled up, with of course the offshore wind one taking perhaps longer, but I think we might see an acceleration in deployment of sort of easier to scale renewable solutions such as onshore wind and solar PV, especially if the sort of permitting environments, the regulatory environment is simplified in Europe in particular. So overall, from a company's point of view, what we see is that large global companies are maintaining their orientation towards the energy transition in a low carbon direction. They're sort of looking at the 5 to 10 year horizon instead of maybe the 2 to 3 years one. And on that horizon, it's definitely the money remains on green. The expectation is that the regulatory environment will continue to push. For example, from a shipping industry point of view, the IMO's carbon intensity index kicks in 2024. The first targets should be complied with by 2030, which is only 7 years away at this point. What we have observed is a little bit of a wait and see attitude in the shipping industry, but our perspective is that actually the regulatory environment will not change. The targets will have to be complied with, and as such, the investments required to comply with the target should begin to be put in place now. And really what the current energy crisis entails is that the investments that are most in the money for the shipping industry are around efficiency and sort of fuel reduction, investing in reducing the fuel required to run the ships, as the sort of sustainable fuels are more longer term. They're likely to be more expensive still in the short term. Supply is still possibly going to be limited, so efficiency investments are really where shipping companies in particular should be looking at. So that's sort of the direction that we see.
Okay. And it's interesting, Alessandro was talking about the fact that, the targets coming up in 7 years to 2030 and the need for investments. From the lending perspective, how can the financial institutions continue to incentivize the energy transition in the shipping market?
I think that's a really good question, and I think so. Over the last 2-3 years, we've seen quite a lot of facilities, ship finance facilities, being sustainably linked, and I think that's a good thing. I don't think it's really going to change the world. You get a couple of KPIs, you meet the IMO trajectory, and we give you a few basis points discount. I think what's coming in play now, which I think is going to have a much bigger impact, is what the banks are actually willing to finance, the assets they're willing to finance. Certainly from my side and the bankers I talk to, it's definitely a shift or trend towards financing newer assets, ideally dual fuel, ideally new buildings, but certainly modern assets that are obviously less that pollute and have lower levels of emissions. And I think that's a trend that will continue. I think the drivers for that is quite a number of factors, but obviously as a publicly listed banks and many of the other bankers here work for publicly listed companies, there's a drive or there's a push from shareholders and society as whole to finance less emitting assets. So that's one driver. But I think fundamentally what's going to be a key driver is the asset risk. Maybe not today, but if you're going to finance a midlife tanker in 5-10 years, certainly you're going to sit down and seriously think about what's the value of that asset at maturity. And I think that's going to be a big push, and I think that's something driven by a real fear and risk perspective, which is certainly as we sit here today, is a much more powerful drive than a few basis points discount if you emit less. So I think that's the key one. Yeah, I think I'll stop there.
Okay, thank you. And so Martin, sort of, hearing Geir's thoughts on that, are you seeing from your perspective any mismatch between the short-term demand for energy and the ability to actually finance the projects, and how is it that you're managing this at the moment?
Yes, we're seeing a huge change in that, and there's a few points that Geir mentioned which actually are very valid. The first one is, what are banks willing to finance? A couple of weeks ago at the Pareto conference in Oslo, Tor Olav Troim told a panel which included the Vice Chancellor of Germany and the head of Energy Norway. He said, the energy crisis is your fault, it's the politicians' fault, because of increased regulation on what produces your power, on oil and gas, on fossil fuels. And he then said, even if I have good projects in gas, which some banks, some part of the community look at as a green-ish solution, I can't finance them because of the regulation you've put on the banks. Now, that to a bunch of investors in the energy space caused a little bit of an uproar, so I'm not going to try to do that here. But he has some very valid points, is that the increased regulation on banks in particular is making it very difficult for us to finance particularly oil projects. The bank market is becoming increasingly segmented between the European, the Asian and other banks because of the different requirements on them. So as Geir mentioned, 2030 is becoming quite a big target for European banks to stop funding oil assets. So from our perspective, things are becoming harder in finding a bank group in syndication. In addition, inflation has run away. Our assets now cost $2.5 billion each at a minimum. So trying to raise that amount of liquidity is becoming a challenge. And that's trying to take into account supply chain issues as well. So there is money available to do what we need to do. The problem is just trying to matchmake it and trying to piece it together in the right way to have the story. Now, the other challenge is, as I mentioned, some banks will look at some of our gas assets. Those are attractive. But practically, all of our assets have oil, sand, and gas coming out of them. What's the split of that? Is going to vary from asset to asset, field to field. And then also the carbon content as well. So some of the carbon content in the gas projects makes actually some banks shy away from financing those. We have started exploring things like re-injection of carbon into oil reservoirs, which adds to the green elements and the emissions. But it's an increasingly complex jigsaw to try to finance what used to be done very simply with long-term project finance.
That's very interesting. Just sort of taking a step back, Geir, you talked about the appetite from the public in terms of the green financing and the push from the shareholders, and sort of, particularly hearing what the others on the panel have had to say. Do you see a scenario where, vessel owners who are slightly behind in terms of their energy transition path do become more bankable because they're so profitable for servicing short-term energy needs?
I don't actually. I mean, I think, look, I think we often heard other panels talk about two-tier markets, and I think that's probably something that's going to happen here as well. I think for our own bank and for most banks in this room, I think the pathway and the transition will just continue, and there's going to be even more push next year and even more so the year after. So I don't think for us to finance someone who is purely profitable today, but not sort of doing their bit, is going to be attractive. Unless, of course, they use that profit then to catch up, I guess, to become more attractive. But I think that's a good thing. I do think there is there's alternative finance out there who's going to look at that and find them bankable. But publicly listed banks, I think, is going to struggle to find them attractive. But it is an interesting dilemma where my understanding of you have a ship which traditionally has been built for 20 years. Obviously, we have a lot of older ships out there today, and the sort of from a global perspective and overall emission perspective, it's actually more beneficial for the world to let them trade out the full life rather than scrap them today to build a new one. With the technology today, which isn't really zero, obviously not zero emission, right? And I think that's an interesting dilemma which might become more and more prominent as we move along the pathway, whereby banks like ourselves would like to focus on the newer assets, but for the world and as a whole, we're probably better off financing an older ship, let that trade out, and then scrap it or recycle it when it's 20, 25 years old. So that's going to be a problem for many owners, I think, and an interesting dilemma for financiers.
And just following on from that, I mean, Martin, what lessons do you think there are for ship owners? I mean, I guess firstly, in answer to the dilemma that Geir highlighted, and also just in general on energy transition, especially considering in a lot of cases, they're not in control of their cargoes or the availability of fuels. So how is it that they should work towards achieving the energy transition with the rest of the market?
That's a very good point. And going back to Geir's question, profitability, actually, owners need to be making a profit. Otherwise, they won't be financeable. So balancing that, and I guess to some extent, what reduction in profit is acceptable to be able to get the finance you need to have a more attractive project, is going to be a balancing act, which is going to become increasingly hard, particularly as the cost of new ships is going to rise. The other issue, particularly for the tanker owners, is that usually their charterers are the same people who are going to be supplying their fuel. So if you have a BP who are chartering to put crude oil on your tanker, but they're not willing to produce an ecologically friendly fuel for you to use, you're the person in the middle getting penalized for not being environmentally friendly. It will probably go in, have a cost impact on cargoes, but that's going to be a longer term consideration, which is going to become very hard for ship owners to address.
And I guess, Alessandro, I mean, the million-dollar question is, in your view, do you think there is a trade-off in meeting short-term energy demands and remaining on track with the energy transition? Or, particularly given some of the comments from the panelists earlier, do you think the ambitions can mutually exist and actually they probably will continue to do so?
I think the answer could be a little bit of both, and it depends very much on sort of the regulatory and policy environment as well. I think I might share personally the comments made by Trafigura that actually we might see an acceleration in the energy transition as the increase in prices of fossil fuels and the uncertainty generated by the political crisis kind of accelerates the intention to move away, and sort of not just for an environmental point of view, but also from an energy security point of view. Then the question becomes how quickly can low carbon alternatives scale up? And I think that comes to some of the policy points I was making in terms of the permitting environments. We might see issues around supply chains. For example, right now a lot of the solar panels, for example, are being produced in China, and the European Union has an anti-dumping tariff regime in place. That might create bottlenecks. It will depend how it gets, if it gets reformed at all, or how that changes, or whether capacity increases elsewhere. to compensate. It will depend as well on the extent to which the increase in fossil fuel prices also translates into an increase in cost for renewables, insofar as they have fossil fuels in the supply chain somewhere for transport or for manufacturing processes. But broadly speaking, I think so far what we are observing in terms of both sort of ambitious clients and the position of governments is that the intention remains to take this crisis as an opportunity to accelerate the transition rather than slow it down. So overall, I think no, there isn't a trade-off. But as I said, there are conditions for this to become true. We could also see a world in which the opposite is true and we revert to fossil fuels, coal demand increases, and we go backwards. I think that is less likely, but it is not impossible.
And Martin, just curious, do you share that view or do you have a slightly different slant?
Generally, I share that. There's going to be increasing dynamics as to how this plays out, and I think there's going to be multiple tracks and multiple directions. So it'll just be challenging.
And Geir, any final thoughts on that one?
I think the energy security is such a crucial point that you mentioned there. I think and that's coming back to my earlier point on the renewables, right? Where you particularly say wind, right? Where you obviously produce in the country or offshore near your country. It's got to be it's got to be so much on the front of the mind of European politicians right now, where they thought they thought they had some sort of security. Obviously, they completely miscalculated that, and we're in a situation where people are, can't afford their energy bill, or actually won't be able to have energy over the winter. So, the pressure on the politicians to fix this is tremendous. But it's going to take time. So, but I think, energy security. It's going to be a key word going forward.
Yeah. And actually, we've all seen headlines of people particularly in Europe in the last few months saying, "I can either eat or heat my house." Do they care where the energy comes from? They just want it lower cost.
Excellent point. I think we're pretty much out of time, but I don't know if anyone in the audience had any questions they wanted to ask the panel. Thank you.